We are not financial advisors. Please do your own research to confirm the information presented here. Also, please subscribe to American Northwest Magazine and click on the thumbs up icon. In today's inflationary environment, managing your mortgage strategically can significantly impact your financial future. One key strategy is to focus on using an interest-only mortgage, where you pay only the interest rather than aggressively paying down the principal. By doing so, you can manage your cash flow more effectively and allow your home equity to grow up to 15% per year due to inflation. So increasing your equity slightly by paying down your mortgage, or in other words, paying some principal every month, might pale in comparison to the amount of equity you will receive due to inflation in such a high inflation environment going forward. We will explain further in this video about why we expect inflation to be so high, perhaps in the 10 to 15% range per year. So, to reiterate the main theme of this video, pay interest only if possible on your mortgage, and once you qualify, consider getting a reverse mortgage in which you would receive money instead of pay money for your mortgage, yet your equity will continue to grow as inflation continues at 10 to 15% per year. And then if your equity grows enough, you can qualify to obtain a collateral loan against your home to get a mortgage on another home, and then rent that home out. In the United States, reverse mortgages are available to homeowners who are 62 years old or older. To qualify, you must have substantial equity in your home, typically at least 50%. The property must be your primary residence, meaning you live in it for most of the year. The most common type of reverse mortgage in the U.S. is the home equity conversion mortgage, which is federally insured by the U.S. Department of Housing and Urban Development. Borrowers can choose to receive the funds as a lump sum, fixed monthly payment, or line of credit. It's important to note that there are no specific credit score or income requirements for reverse mortgages. However, HUD requires all reverse mortgage borrowers to complete a counseling session to ensure they understand the terms and implications of the loan. In Canada, the situation is somewhat similar. The national debt is around 1.50 trillion USD, approximately 2 trillion Canadian dollars. For the fiscal year 2023-24, the Canadian government will spend $46.5 billion on debt servicing charges, nearly matching what the government expects to spend on the Canada Health Transfer. Combined federal-provincial interest costs in major provinces like Ontario, Quebec, and Alberta are nearly as much or even more than what these provinces will spend on K-12 education in the same period. To finance its debt, Canada also issues bonds, including government bonds and treasury bills, which are sold to investors. This increase in money supply can lead to inflation, which, like in the US, drives up housing prices and home equity. Reverse mortgages in Canada can be a valuable financial tool for seniors looking to access the equity in their homes without having to sell or move. To be eligible for a reverse mortgage, homeowners must be at least 55 years old. You must also have at least 55% equity in your home, meaning the amount you owe on any existing mortgage and liens must be no more than 45% of your home's current value. The property must be your primary residence, where you live for at least 6 months of the year. The amount you can borrow depends on several factors, including your age, the value of your home, its location, and the amount of equity you have. Typically, older homeowners and those with higher valued homes can access more funds. Inflation plays a significant role in home equity growth. As inflation increases, so do home prices, which in turn boosts the equity in your home. This can be advantageous for homeowners who are making minimum payments on their mortgages with an interest-only option, as their equity continues to grow due to rising home values. When you eventually qualify for a reverse mortgage, you can tap into this increased equity without having to sell your home. In the United States, the national debt has reached a staggering $36 trillion. The government spends over $1 trillion annually on interest payments alone. This massive debt, coupled with high interest payments, puts a significant strain on the economy. Instead of directly taxing citizens to cover these costs, the government borrows money, primarily through issuing treasury bonds, notes, and bills. Investors buy these bonds with the expectation of receiving interest payments, and the government uses the funds to finance its operations, including paying interest payments on the national debt. However, borrowing money through the issuance of bonds, just to pay off our interest on our $36 trillion debt, will lead to higher inflation. Also, the tariffs that Trump has implemented, causing a trade war with at least Canada, Mexico, China, and Europe, could cause hyperinflation. As inflation rises, the cost of living increases, including housing prices, which in turn boosts home equity. In an inflationary environment, leveraging real estate can be a powerful strategy for building wealth. Also, you should consider storing some of your wealth in Bitcoin, which will increase in price as higher inflation kicks in. As mentioned earlier, one effective method is through the use of interest-only mortgages. By focusing on paying only the interest, homeowners can maximize their cash flow while allowing home equity to grow due to rising property values. But how can this be turned into a wealth-building strategy? Here's the process. First, as we mentioned earlier, as the equity in your primary residence increases, you can use this equity as collateral to purchase a second property. This is often done through another interest-only mortgage, allowing you to continue focusing on paying interest while the equity grows. As the equity in both properties increases, you can use the combined equity as collateral to purchase additional properties that you can rent out to other families. This creates a cycle of acquiring more real estate assets, each contributing to the overall growth in equity. To qualify for loans using the equity in existing properties, lenders typically require a certain loan-to-value ratio. This means the loan amount should not exceed a specific percentage of the property's appraised value. By having substantial equity, homeowners can meet these requirements and secure additional financing. Recent years have seen inflation rates in the U.S. reaching around 8% CPI, significantly impacting the cost of living and home prices. However, real inflation was more like 10 to 15% if you include items not included in the carefully procured CPI numbers. Things like energy, real estate, rents, and many other things that we pay for outside of the CPI basket created to make inflation appear to be much lower than it actually is, primarily so that the cost of living increases in Social Security remain low and not realistic. While it's less likely for inflation to consistently hit 20% annually, it is very possible and maybe likely that we will be looking at 10 to 15% over the next few years for the reasons mentioned previously in this video. To summarize, in a high and increasing inflationary economy, it might be best to pay the minimum amount on your mortgage, in other words, interest only. Once you qualify for a reverse mortgage, you should seriously consider applying. When you qualify to buy another house using the equity in your current houses as collateral, get another one and repeat the process. Of course, you can rent out the other properties to cover the mortgage payments, creating a sustainable cycle of wealth generation through real estate. Stay tuned for a closer look into the specifics of how these strategies play out in different economic environments. In Canada, the situation is somewhat similar. The national debt is around $1.50 trillion USD, approximately 2 trillion Canadian dollars. The Canadian government will spend $50 billion Canadian dollars on debt servicing charges in 2025, nearly what the government expects to spend on the Canada Health Transfer. Combined federal-provincial interest costs in Ontario, Quebec, and Alberta are nearly as much or more than what these provinces will spend on K-12 education in 2025. To finance its debt, Canada issues bonds, including government bonds and treasury bills, which are sold to investors. This increase in money supply will lead to inflation, which, like in the US, drives up housing prices and home equity. In Canada, reverse mortgages can be a valuable financial tool for seniors looking to access the equity in their homes without having to sell or move. To be eligible for a reverse mortgage, you must meet certain criteria that are consistent across the country. First and foremost, age is a crucial factor. Homeowners must be at least 55 years old to qualify for a reverse mortgage. The equity in your home is another significant consideration. You need to have at least 55% equity in your home, which means that the amount you owe on any existing mortgage and liens must be no more than 45% of your home's current value. This ensures that there is substantial equity available for the reverse mortgage. Additionally, the property in question must be your primary residence. This means that you need to live in the home for at least 6 months of the year. It's also important to note that the amount you can borrow depends on several factors, including your age, the value of your home, its location, and the amount of equity you have. Typically, older homeowners and those with higher valued homes can access more funds. Inflation plays a significant role in home equity growth. As inflation increases, so do home prices, which in turn boosts the equity in your home. This can be advantageous for homeowners who are making minimum payments on their mortgages with an interest-only mortgage, as their equity continues to grow due to rising home values. When you eventually qualify for a reverse mortgage, you can tap into this increased equity without having to sell your home. While we've explored the nuances of reverse mortgages and national debt in the United States and Canada, it's essential to understand that these financial mechanisms and debt dynamics are part of a larger interconnected global economy. Globally, countries are grappling with soaring national debts. Japan, for instance, holds the highest national debt relative to its GDP, exceeding 260%. This staggering figure highlights the complexity of managing national finances in an era of economic uncertainty. In Europe, nations like Greece and Italy have faced severe debt crises, leading to austerity measures and economic reforms that have had profound social impacts. Emerging economies such as Brazil and India are also navigating their unique debt challenges. These nations often face higher borrowing costs and volatile currency fluctuations, which complicate debt servicing and economic stability. The interconnectedness of these economies means that financial decisions in one country can ripple across the globe. For example, a significant policy shift by the Federal Reserve in the United States can influence interest rates worldwide, affecting borrowing costs and debt management strategies in other countries. Understanding these global debt dynamics is crucial for policymakers, investors, and individuals alike. It underscores the importance of strategic financial planning, not just at the national level, but also for households and individuals. By staying informed and making prudent financial decisions, we can better navigate the complexities of a world where debt and economic interdependence play a pivotal role. As we conclude, please consider subscribing to American Northwest Magazine. Whether you're considering a reverse mortgage or simply managing your finances, staying informed can help you make the best decisions for your financial future.